Axel Weber has held some of the most influential and important roles in European banking. He was the president of Germany's Bundesbank and a member of the ECB Governing Council from 2004 to 2011, which included the early years of the global financial crisis. Santander is one of the oldest and biggest banks in the world, with a footprint in Spain, Brazil, the UK, and the United States. It's a truly global bank with more than 100 million customers. When Emilio Botin, the executive chairman, passed away in 2014, his daughter, Anna Botin, took over from her father and quickly implemented a share sale of a 7.5 billion. In June 2015, after his predecessor stepped down, Bill Winters was picked to turn the company around as CEO. He scrapped Standard Chartered dividend, sold the 19 businesses, and hired new management. He's no stranger to the banking world. He spent 26 years at JP Morgan and was the co-CEO of its investment banking unit for about 5 years.
Axel Weber has led in turbulent times for Europe, being at the helm of the Bundesbank during the start of the financial crisis. He's since moved from central banking to the private sector, taking over as chairman of Swiss banking giant UBS back in 2012. So, what kind of leadership styles does it take? We're back with Axel Weber. Axel Weber, thank you so much for joining us. You have a great global view of the main challenges facing financial institutions. What are they? How will this industry be transformed in 10 years from now?
I think the industry is in the middle of a transformation already. The first 10 years after the financial crisis, largely so a re-regulation of the industry. And many, including UBS, have changed their business model. We were among the first. And now, over the next 10 years, there will be different trends that will shape the industry. Technology is one of them. Overall, the business model will, in my view, be challenged by disruption. And the question in the future will be, can incumbents, like UBS, raise to the challenge and basically transform themselves rather than being disrupted? And we've seen disruptions in many industries. Technology is the key driver for that. I think banks will continue to face those challenges. So I think we will rise to the challenge. We will basically adopt what is good through financial technology. The business model will change. It will become more technology driven. It'll become even more client centric, because the main beneficiary of these technological disruption will be the clients.
But how will the big banks not be disrupted, left behind? How do they not, become obsolete?
I know. What will get disrupted is banks that have in their business model a core model that has no distinguisher. Many banks like ours focused on one business area. I wouldn't say niche, because we're the largest player in the world in wealth management, where content matters, and content will matter even more in the future. The client experience will change through technology, but clients are getting more educated about financial markets through technology. Clients are more risk sensitive. They have a different interaction with the banks through technology, and banks that will assimilate that into their business model but continue to provide content and be industry leaders, they will survive.
But so do you think UBS is a little bit of a blueprint for the rest of the European financials?
Not necessarily, because we wouldn't want everyone to move into wealth management, and nobody has the core strengths in the home market that we have. It's a small home market, but it's a very lucrative market. And also, because of the small size of our home market, we were very early forced as Swiss banks to be very international. And I think at the moment this internationality helps UBS.
But what are the risks associated with wealth management, especially wealth management for very high net worth individuals?
Well, we're seeing an opportunity there. So if you look at what we've recently announced with our Investor Day, we actually think that the current trends in the markets will continue to produce one byproduct of this QE and monetary policy easing that is unwarranted, in my view, undesirable. And that is an increasing difference between the best performing in the economy and the least performing. So inequality is going to rise. It will continue to produce very high income and very high wealth in many of the affluent parts of our societies, and the middleman will continue to feel somewhat left on the sideways, and that will continue to offer opportunities for large banks who can basically focus on the wealthiest of their clients and on the most affluent in the society, and UBS is one of those banks that has a long track record in that and continues to work with these clients.
But don't you service the globalists? And if there is this, wealth inequality increasing, then it means that there may be even more populism and more of like anti-globalization sentiment. So it hurts your clients.
It hurts your clients, but if you look at the potential of those top clients in China, what happens is almost every day a new billionaire emerges in Asia Pacific. So yes, there is some disruption, I would say, for the average economy, but for the most affluent parts of our societies and for the most dynamic parts of our economy, globalization is a fact that will continue. There will be some challenges, there will be headwinds, but I think 10 years after the crisis, usually these populist arguments are getting more and more headwinds as the economy emerges from the crisis, and I think that's what we're starting to see. If you look at the French election or some others, yes, there are nationalist movements and there's populism, but actually internationalism has scored some points also recently. And I expect as the economy continues to heal from the crisis, many of the angry voters that look at the crisis and how they've been hurt will feel that the new developments in the economy work for their better life and actually are starting to feel less angry about the crisis.
But Axel Weber, what exactly do you think the future for these big European, universal, global banks is? Are some going to fold? Are we going to see a consolidation?
You're going to see consolidation in the industry. You're going to now still have some calls occasionally for a national champion. Right. I don't think that's going to work. What Europe needs in order to catch up with American firms is European champions. Banks that are larger in size.
So cross-border.
Cross-border banks, pan-European consolidation, and that's actually a bit against the sentiment of what regulators have been engineering, where basically too big to fail has led to a lot of regulation geared at the most complex and largest financial institutions. And we're seeing in the US that trend gets slightly reversed. There's still a lot of regulation for the top banks, but some of the mid-sized banks find it much easier to get regulatory breaks, and that will enable them to basically start merging, and in Europe you will see the same.
So what, in 10 years we're going to have 5 banks, 5 big European banks or more?
No, I think you're still going to have quite a few more banks, but you at the moment don't have any pan-European bank. You will see 3 or 4 pan-European banks that will be true pan-European in the sense that they'll cover the entire Euro area or the entire EU, and being a Swiss bank and being global, we will continue to be a competitor in these pan-European banking markets and also in the global market. So you will see not just domestic banks become more pan-European, you will also see US banks taking a bigger stake in Europe and in Asia because their clients will want global exposures and global banking as well.
What kind of transformation digitally? I don't know whether it's automation, robotization, or it's just finding a different language to speak to millennials that will be your biggest challenge.
I think the challenge is going to be that banks have now tried to drive digitalization themselves. Yeah. I mean, at the core, banks are technology companies. But what will happen with disruption is banks will monitor the successful in the market of the fintechs, and they will basically work with them, integrate them into their value chain, integrate them into what they're doing, and become better banks with the same client experience that the client is looking for outside. Plus, they bring the scope, they bring the size, and they bring the globality that many of the fintechs would work decades to get at. And so I think you're going to see the most successful fintechs become parts of the establishment in banking through mergers, through acquisitions, through collaboration, and that's going to sort of give them a big incentive to be successful fast, because then they can work with the incumbents for better banking solutions.
There's no shortage of flashpoints in the markets now for European banks to contend with. Political risk is back in a big way in Italy, Germany, and the UK. Central banks are unwinding from their decade-long emergency monetary policy, and the world's 2 biggest economies, the US and China, are involved in a trade spat that doesn't seem close to resolution. You were pivotal in dealing with the financial crisis as head of the Bundesbank back in 2008. What did you wish you knew back then that you know now?
I think what we, at the time, what we experienced is almost like a cardiac arrest of the global economy. And like with a lot of cardiac arrests, it takes a long time to heal. It takes a long time to recover. I think the expectation at the time was if we fix these problems, we can go back to normal. We haven't gone back to normal, and we'll never go back to the old normal. The world has moved on. Markets are different now. Some products are gone, I think for the better. And in the future, it's all going to be about how can we navigate this more complex world where sort of complexity is ever increasing, and that's really the challenge in financial markets. And central banks are only, in a way, providing liquidity to banks. What you really see now with market-based finance increasing, with a lot of risk migrating away from banking, which is better regulated now, into market-based finance, central banks will find it harder in the future to provide liquidity to problem areas because they will not be the core counterparties like banks that have access to central banking. So I think what you need to do is you need to rewrite the rules of regulation and banking and central banking for more complex financial markets, including capital markets, which in Europe is still a project. I mean, capital market union is a project, it's not yet there. But capital markets will become a reality in Europe, and central banks aren't equipped for that reality.
But so are you concerned that, for example, the banking union, right, the rules will be obsolete by the time we have a banking union?
No, I'm just concerned that we know how to deal with failing institutions if they were banks. Too big to fail, resolution, recovery, liquidity planning, capital planning, all of that focuses on the banking industry. Well, what do you do when the risks migrate to the non-bank financial segments? Central banks are still the core institution that need to stabilize the financial system, but they have much less information day to day from the non-banking world than they do from banks. And we see it in some buoyant markets. Credit risk is migrating to the insurance companies, to pension funds, to market-based finance, and the central banks that want to regulate banks can't really stop a boom in credit markets just by giving banks tighter credit conditions. So liquidity matters and markets matter a lot more, and central banks have to become much more market focused in what they're doing, and at this moment many central banks haven't really got that experience.
So where do you see the next crisis coming from? I've heard everything from shadow banking in the US to shadow banking in China. Is China the kind of the pivotal thing that, again, a lot of our policymakers definitely can't regulate?
I'm not that concerned about China, because China in the past has always been able, with the central bank, to focus on problem areas emerging. It's still a centrally run economy, and if you look at financial markets, they're just starting to develop. They're massive in size, but they haven't really got a large complexity. Regulating non-complex financial markets and stabilizing them is much easier than doing the same in a very complex, sophisticated financial system. And so I'm not that concerned about China. Yes, there are some headwinds, but I think the authorities are focused on that, and we've seen already the disbursement of some anti-cyclical, counter-cyclical stabilization measures. I think those will continue to be used, and I think they will help stabilize the Chinese markets. Where I do see some headwinds is really in non-market-based finance in more complex systems like the United States. At the end of a very long cycle with a lot of distortion in risk-taking through monetary policy, there's going to be some risks that have been taken that really, as monetary policy continues to normalize, will come to the fore. And that's really where I think we need to be prepared for.
But we understand the linkage, right, which we didn't in 2008. So if there's something ugly happening, will we be able to intervene quicker?
Well, we just wrote a report of the Group of 30 which said, yes, in principle we understand the linkages, but the problem is that some of these early dispensed measures in central banking have really by now been much more restricted. For example, require parliamentary approval. And if you remember, TARP, when it was first discussed, was actually not passed by the US Congress, and it had to go back a second time to be passed. So yes, I think we know what to do, but it'd be much harder to master getting parliaments behind some of these additional measures if we were to embark on them again. I mean, the one thing financial crisis has shown is a lot of the early intervention was very unpopular, and now central banks will be much less able to do it as quickly and as uninfluenced by parliamentary processes than in the past. So things will get a lot more discussed between policymakers and central banks.
Is populism actually a sideshow or a consequence of the financial crisis?
I think to some degree it's a consequence because, as I said before, there's a lot of inequality that emerged as a side of it, because if you focus on a policy that basically supports equity markets and risk-taking, by design. I mean, QE was designed to improve risk-taking capacity, and the ones that are able to take risks are the ones that are financially better endowed, and that has created huge returns for those that invest in equity markets. But fixed income, which many of our European citizens are still largely invested has really been having depressed returns over the recent decade. And so some of the side effects of monetary policy is contributing to the inequality. I'm not saying it's causing it, but it's contributing to it. And that is something that will make a similar set of monetary policies much more difficult to master next time around.
Axel Weber, what does it mean being a leader today?
Well, sometimes it means taking difficult decisions, taking decisions where you're unable to consult with a lot of people around you, where you basically have to show leadership at a short moment in time. My experience was in the financial crisis, we had to do that. And very often I saw the role of the central banks as providing collective rationale where sort of the individual rationale would have not led to a solution of the problem. And so in the financial crisis, all leaders of financial institutions behaved individually for their institution rationally, but the sum of all these behaviors would have amounted to a major financial crisis. And so the central banks had to come in as the provider of a collective rationale that basically led to a better outcome. And that's a sense of leadership where I feel that providing that collective rationale was something that many of the central banks and political leaders did at the time. And in my view, that was key for solving the crisis.
Do you remember a particular day, a particular hour, a particular phone call in 2008 where you thought, oh, this is looking ugly?
Well, 2008, we were already 1 year in crisis mode. I remember July 2007, where we had the first bank globally, IKB Bank, get into trouble. It was a AA bank, and we had to provide a solution for that bank within a short period of time over a weekend before the markets opened in Japan again. So that was really bringing everyone to the table and recognizing that the group of banks that had exposures to that single player were better off supporting that bank than insisting on the bank going it alone. And we've been having many, many repercussions like that in financial markets till we came to 2008. 2008 was the time where we ran out of individual solutions, where you gather people around the table that were banks or financial market players. At that point in time, we needed outside money. We needed taxpayer money. We needed politicians to come to the solution of these problems. And that's where in Germany, for example, we had a 500 billion program set up that really helped us solve these problems. It was very unpopular, but it was the fastest piece of legislation in the German parliament within a few days. And Chancellor Merkel, who's still the chancellor in Germany here, and Minister Steinbrück really went through all the parties. They asked me to come along, and we talked to all of the parties to get this going. That was, in my view, the most difficult time we had.
I mean, was it the most difficult day, or was it the day that you decided not to run for ECB president?
No, it was a difficult day. That was much later. I think the reaction of the ECB to the crisis had been that the ECB over time became the repair shop for a lot of bad banking decisions, bad fiscal decisions by member states.
But that's a central bank, isn't it?
Well, for fiscal decisions by member states, you can argue that. I think there was a tried and tested avenue at the time. For example, if a member state of the European Union, in particular a small one like Greece, runs into trouble, the IMF could have been brought in to help with their programs, which are tried and tested for solvency crisis of states, solve the issue. The Europeans decided to not bring the IMF in a sole responsibility, but basically to escalate the problem to the ECB and to Brussels, to the Commission. And that's where I think it became difficult, because the resolution that was asked for involved a lot more European money at the table than really the collective rationale of the IMF. I was never a fan of that solution. And since, sometimes in life things bifurcate, since we went down that road of Europe tries to solve this problem alone, we got deeper and deeper into the problem. And the ECB still is, to some degree, the repair shop of markets and of broken governments.
But of course that bifurcation meant that you decided that you could not be actually ECB president. Was that a tough decision?
No, it wasn't a tough decision. No, I've been somebody who always felt that I'm doing a job if I'm convinced about what I'm doing, and if I'm not convinced about what I'm doing, I'll do something else. And I've been an academic for many, many years. I loved being an academic, but I felt I want to have some different challenges in the future, and so I became a policy advisor, then a policymaker and a central banker, and now I run a private organization. And I find these different trades of life exciting, new challenges, and for me, it is something that I like doing. doing. So I'm never tie myself down to a single job that I do for the rest of my life.
So what's the piece of advice you give to interns? I don't know if somebody, wide-eyed, bushy-tailed intern and says, Axel Weber, what's your secret sauce to a lifelong career?
Well, basically, when I was an academic, I was fascinated, which I said I love being an academic. I was fascinated by meeting the 19 to 24-year-olds who basically then decide how they want to have their life in the job, how much time to invest, how much education to invest. You see that less if you're at the top of a financial institution. So I go out deliberately through our younger leader clubs. I go and visit branches in where we have young people, and I keep telling them that they got to invest. They got to invest in training. They got to invest in education, and basically they got to invest in being at a very good company and getting to the top by commitment, by looking at what we call in UBS our behaviors and principles. So focus on what you're doing, be long-term oriented, and if you're in the financial services, focus on the clients, try and look at sustainability and challenge. If you see something that you think is a problem, challenge and have the self-confidence to go it your own way.
But can you, are you born a leader or can you become a leader?
I think you can become a leader. I think people are born with a set of natural instincts and with some curiosity, but it really depends what you do with these natural instincts and how you develop your curiosity. My sense has always been you got to have an inner compass. And for me, what mattered all my life was that inner compass. I don't mind if people disagree with me as long as I'm convinced that from my inner compass, I'm still going in the right direction. That's what matters. So when I ended my career in central banking, it was a deep conviction that the direction we were traveling was the wrong direction for me. Not saying it was the wrong direction, it was the wrong direction for me. And now in banking, when I came to banking, I didn't have a lifelong career in banking. It was the importance of knowing where you want to go to, focus on the long-term sustainable business parts of your business, move away from high volatility in market-based finance, and really focus on things like wealth management and retail banking as core of the bank. So it really has to come with some convictions that either you go for short-term profit or you go for long-term gains. Going for long-term gains requires a lot more commitment, it's a tougher road, and it has setbacks. You got to live through those setbacks, and I'm still committed to that longevity in everything I do.
So what's the best piece of advice you were ever given throughout your career, either young or less young, and who gave it to you?
I think I was given that by my parents, and that was trust in yourself, because in the end it has to be right for you. And that's what I always ask myself. I don't want to please anybody if I don't think that that's the right thing to do. So I have some confidence in the fact that I believe what I want to achieve. And if there are things that I see that I don't like, I say it. And if I want to help move a bank in a certain direction, I only do that if the direction is right for me. And being a leader, you have the advantage of shaping that direction. Because if you have a compass, you're at the steering wheel, you can determine the direction of your institutions. And at UBS, we have a great leadership team, so we have a dedicated group of people that all want to do the same thing, focus on longevity, really look at sustainability, and make banking better, not just as a short-term profit, but as a long-term direction.
Bill Winters, thank you so much for speaking to Bloomberg. Such a pleasure to speak to you again. Give me a sense of the overhaul. How are you settling in? How's it going?
It's been going well. We are, the thing that attracted me to Standard Chartered in the first place is a fabulous franchise, great history, really exciting markets, clients that know the bank well and like the bank a lot. This was all my sense from the outside. And I came knowing that there was plenty of problems as well. Now, that's the only way you get a chance to come into a bank like this. Knew that there were problems and expected that the external environment would be challenging. So here we are, coming on a year since I agreed to join, and I guess 10 months since I did join, and it's everything that I expected. So we've got a great underlying franchise with a ton of opportunity. We had a ton of problems as well, which I tried to be very transparent about as far back as August when I made my first public statements about the bank. We set out a very robust program of actions, and we're doing it. The earnings are poor. I mean, the profitability is poor. But we said we were going to do a bunch of things, and we're doing them. And I think the market took our earnings as something of an encouraging sign, because I believe that what the market understands is what our clients have always known, which is that there is a ton of business for us to do and that we're really well positioned to do it.
But impairments were better than expected. Is that a trend of things to come?
Yeah, better than expected. I'm not sure what that means. Our stock has been up and down like a yo-yo, and not always on a lot of real information. But the fact is, we had overextended ourselves in a number of areas. We had some concentrations, both single name and by industry, and they happened to be the areas that were hardest hit. Probably not a coincidence. I mean, there tends to be more demand for money from people that get into trouble. We identified the problem before I arrived, and we're very transparent about the single name and industry level concentrations, and we dealt with it. So we said at the year end that we're comfortable with our portfolio. Now we know we have a lot more to do. We've got a portfolio of assets to be liquidated that are work in progress, and we had some concentrations that we're still watching. But broadly, our portfolio is in good shape.
Can you talk to us about your dividends? You've had to cut it back, understandably so.
Yeah, we don't have one right now. So we cut back our dividend at the half year last year. We canceled our end of year dividend, so zero. We did that in part because we were asking our shareholders for incremental capital, and it seemed silly to ask for 5.1 billion and pay 700 back out. But more importantly, we said this is the time to reset our thinking. And we understand that our shareholders care about the dividend, they want a dividend, and we want to pay a dividend. But we want to resume the dividend at a time when we have a visibility into our earnings and a demonstrated capital strength that means that we can sustain that dividend.
So this year or not?
It's possible. We've said that we understand how important this is to shareholders, and we'll resume the dividend as soon as we think it's appropriate.
How do you increase revenue in this kind of environment?
That's the big challenge. So what we experienced over the course of last year is shrinking demand for our balance sheet at the same time as returns were being compressed, largely because of strong local competition. Mm-hmm. The good news in the first quarter is that we halted the decrease in our balance sheet and halted the decrease in income. Yeah. But the income level is still suppressed. Part of that is that we have underinvested in parts of our franchise for many years. We're investing a lot in this business right now. We're going to save $3 billion from our operating expense, and we're putting all of that back into our core franchise. Infrastructure, client relationship managers, building out in our key geographies where we have a real competitive advantage. That's the key way to get income up, is just to build productive capacity. We also know that we have a really big set of client relationship managers that were very focused on one set of measures historically. And it was really around growing income at the top line, not so focused on returns. We've shifted the focus much more towards returns, and there's always a risk that in that transition, you lose the focus on growth. Right. I think we've got the balance right. So our relationship managers are now both trained and focused on getting that market share up, getting that client flow up. We need clients that are investing in their own businesses, and that's been the other problem.
But it's a very fine balance. So are you ready almost to take a loss for the year to make sure that you get a market share that you're happy with? Our market shares
across our key geographies and products is actually very good, and it hasn't come off materially. We've seen some slippage in some markets in retail, but most of the income downdraft that we've experienced has been the result of lower commodity prices, lower levels of global trade. So last year was the first year in a long time that trade has grown at a slower rate than underlying GDP.
But so you could post a loss for this year. It's not impossible. And
well, it's not impossible. We earned a bit over $500 million in the first quarter, so we'd have to do that much worse in the rest of the year to generate a loss. So you never say it's impossible. But I'm hoping that we can grow income over the course of this year. I think we've demonstrated a good control of expenses so far. The loan impairments is a wild card, and obviously if one of the bigger exposures has a surprising turn for the worse, that could have a material impact on us.
What about litigation? Is that the bulk of the costly litigation? Is that behind you?
Litigation probably, but we've been very transparent about a number of open investigations that we have with U.S. authorities and with the FCA relating to anti-money laundering compliance and sanctions compliance going back to 2012 and a little bit beyond. Those are open investigations. We can't know when those will conclude. We would love for them to conclude soon, but they have to run their course. Of course, we're cooperating as fully as we can, and we're doing our own investigations. I'm comfortable from everything I've seen that nobody in the bank intentionally misled.
Emerging markets have been hurt by concerns over bad debt and not enough structural reform. I asked CEO Bill Winters about his outlook on China's economy. Are you a little bit more positive on China than you were just 5-6 months ago? It seems the economy is stabilizing a little bit. Yeah. We have seen a little bit of companies going through default, but overall it feels a bit better.
Yeah, it does feel better. And I was probably never in the doomsday camp. I suppose if I had been, I wouldn't have come to do this job in the first place. But there were clearly some policy fumbles back in August of last year and then at the end of last year, beginning of this year, where there was a failure to communicate intentions with the market about the underlying equity market, the currency markets, et cetera. Against that backdrop, the actual economic activity is very good. So
if you believe the numbers.
No, you can discount the numbers by a fair amount. It's still pretty good, although I think the numbers are fair enough. There is a clear shift towards a service and consumption-based economy. There's a growing and I think demonstrated resolve to deal with the capacity overhangs from the state-owned enterprises. A lot of the growth, I think it's real. It is the result of a substantial increase in the debt stock. And no doubt that debt stock is effectively a policy matter. So the big state banks and the capital markets are encouraging debt creation. And that, of course, is mortgaging the future. But how much of that 6.8% growth is simply manufactured through increase in debt and continued capital spending versus real underlying growth? I think that the majority of it is real underlying growth. And most of us would be quite happy with 4 or 5% growth with no incremental increases in debt stock, especially in the second biggest economy in the world.
So you're not really concerned about defaults, right? You're still quite active, or you will be quite active in China. I know you're playing RMB, for example.
Yeah, we are active in the local lending and the local capital markets. But of course, we're concerned about defaults, and there has been an increase in non-performing loans, still manageable.
They're managed, right?
They're manageable and managed. The quality of our book in China is very concentrated towards investment-grade companies and very concentrated in the banks. So, and the large banks, because we're a trade bank, we're facilitating payments. So the nature of that business is pretty encouraging. But where we have a broader-based commercial banking and corporate banking business, we're seeing some stresses and strains as the economy adjusts. In particular, in the call it the more old economy areas. But we think this is manageable in the overall scheme of things.
What are the three biggest risks that you see out there? So I would point to China, possible Brexit or implosion of the EU, a policy mistake from the Fed, and also maybe liquidity on the markets.
My biggest concern really is that the cumulative effect of extraordinary monetary stimulus over a period of time, together with an element of fiscal stimulus, obviously that is differing from region to region. Cumulatively, that's building up some pretty big imbalances, and it does feel a little bit like a rubber band that's being stretched. That there's a risk of snapping, and I think a lot of the pressure on banks to increase their capital position is intended to have the resiliency to see through a bit of an unexpected shock. But so I think that's really the macro theme to watch.
But a shock like what? A possible recession, a possible, again, freezing up of liquidity in the markets, or even a systemic risk coming from a big commodity, for example, trader going under?
Yeah, I'm less worried about the systemic risks, although we should never ignore those. But I think the little wobble that we saw last year, when there was a concern that increasing monetary stimulus, in that particular case in Europe and Japan, was just having diminishing returns, and the sense that may be the only tool in the arsenal.
Although it's backfired, negative rates really hasn't worked as people were expecting.
There are consequences to negative rates. Right? We've not played this one out yet, and no one knows exactly how it ends. So I think we have to be careful of and aware of that. That's part of the reason that I'm comfortable sitting here in an extraordinarily well capitalized position with very strong liquidity, is to be resilient against some of the things that we're concerned about but don't really know how they will play out. But the other risks that you mentioned are real as well. So the market obviously became very concerned about the combination of a tightening Fed and a China whose objectives were a little bit unclear.
Are you concerned and Janet Yellen has been extremely dovish, if she becomes a lot more hawkish in the next couple of weeks or months, what does that do to emerging markets and debt?
Yeah. I think the emerging markets are much better prepared for a growing interest rate differential relative to what they were a year or 2 years ago. But as we saw last year, and as we saw from the volatility this year, a little bit of jitter, a little bit of stimulus creates a lot of jitters in the market. So I think the Fed's got to be very careful. But by the same token, we've had a rate increase. I fully expect that we'll have another and maybe 2 more this year. I think the market can handle that.
What do you expect commodity prices to do?
Look, we've had a good run back up. We still have a supply surplus in the oil markets, less so in some of the other markets. And I think we've probably reached a reasonable equilibrium for this supply bracket. But we continue to have growing demand. And at the end of the day, whether the 6.8% growth in China is precisely right or whether it's relatively debt-fueled, it's still 6.8% growth. And the demand for oil coming out of China and the United States, even at sluggish growth, and Europe, even at sluggish growth, is positive. So, and supply it has begun to come off and will begin to come off as the high-cost producers capitulate. So I think we'll see a stabilization of commodity prices around this level with an upward bias.
Given what you've just said, where do you see the bright spots? Because if you look at the world, so I know there's China, they're still growing. World growth is very sluggish. We've thrown a lot. Central banks have thrown a lot.
Yep.
And actually, forecasts for growth aren't really going anywhere.
The bright spot closest to home is that the banking system is extremely resilient right now. So we've got much, much higher levels of capital than we did just 3 years ago, much less 5 or 6 years ago, and much more liquid. The fund industry is much less leveraged than it was. So the capital markets broadly are in better shape. So I think there's a better shock absorber in the system than we've had before.
And this is worldwide?
This is worldwide.
US, Europe?
Absolutely. I mean, the U.S., I think, got there faster. Europe is getting there slower. The U.K. is in between. But I feel very comfortable with our capital position. And, we could absorb, as we did, via the Bank of England stress test last year, a pretty severe shock. And we'll have a stress test this year that will be even more severe. And I'm sure we'll absorb that as well and be able to carry on with our business. So that's one very good piece of news. Second is that most of the world is still growing. And it's not growing as quickly.
A little bit.
It's not growing as quickly as it did. But the underlying demographic trends in the parts of the world that are still growing are very good. So China in the short term is okay. In the long term, we know that there's a challenge. But the rest of Asia, India, which is booming, East Africa is booming. Commodity exporting Africa and the Middle East are more challenged. But across these markets, we still have growth with good underlying demographics. And this is an increasingly large part of global GDP. So I think we can get very doomsday about the risks, and there are plenty of them. And we must be ready for those risks. But in aggregate, the world feels like it has every opportunity to get back to a stable, albeit lower, level of global growth with more balance and a more resilient financial system.
You mentioned currencies. Is it the end of the dollar rally?
That's a big call. I think the dollar rally is clearly connected to the whole risk-off theme that we've had on and off, but on balance, a risk-off theme over the past year. And I think it's too early to call the end of the risk-off theme. I think we could have episodes of real risk aversion, and I think that would give the dollar some legs.
So you're expecting volatility and kind of seesaw markets and currencies?
I'm expecting very high volatility for the rest of this year and probably into next year.
I asked CEO Bill Winters what kind of bank he wants to build.
What we have today is a great international bank, focus on trade, payments, and serving the emerging affluent, both at an individual and a corporate level, in Asia, the Middle East, and Africa. Right? So we start with a fabulous franchise. We looked very hard at whether there were big chunks of that franchise that weren't critical for our future. And we've decided and recognized that we have fantastic opportunities in retail, we have fantastic opportunities in commercial banking, and we have a very strong corporate and institutional business that we want to continue to grow. So what we would like to be is a much better run version of what we are today. Now that will involve lots of ins and outs. We sold 19 businesses last year. We're selling a bunch of businesses right now. We're investing heavily in our underlying businesses. So far, all of that investment is organic. I think that's the right thing to do when we're also tightening up our controls. But there are and will be inorganic opportunities at some point. So when we're ready to deal with those things, I'm not talking big acquisitions. I'm talking about just build outs around our core strengths.
But what needs to happen to be at that point? The oil price stopping to fall, or are you looking more at Asia instead of the Middle East?
So we're doing what we need to do to get to the place where we have all the options open to us. The first was to strengthen our foundations. So that was get our capital position rock solid. Yeah. And we are just in a good place right now. Second is to really tighten up everything around our control environment. So that's risk controls, it's expense controls, it's conduct and compliance controls. Thankfully, the ethical culture in the bank is fantastic, but we were a little bit loose in terms of the way that we just kept track of things. And as a result, little mistakes got amplified, hence the very bad financial year last year and the challenge getting out of that. But we need to execute better in everything that we do. It's investing intelligently. Yeah. It's creating real long-term franchises off of our core strengths. That's what we're doing.
But how do you marry with cutting enough fat and at the same time giving it enough time to play out?
You know, our shareholders have, I would say, have been quite supportive. So we went to them with a strategic plan last year. We said that it was a 3 to 5 year plan. We set out, recognizing that we identified a relatively poor operating environment with low growth, low commodity prices, low interest rates, regulatory headwinds. And in that scenario, we said, we'll get to 8% returns in 3 years and 10% returns in 5, which is not a very exciting set of returns. So we said to our shareholders, we'd like you to invest $5.1 billion into your company, and that's what we can do for you in the short term. In the medium to long term, we think we can create real value because this is a special place. And 90% of our shareholders signed up for that deal, including me and every other member of our management team who both bought shares just with our own money, but also followed our rights in terms of the rights offering, and who further agreed in terms of this year's bonus round to forego any cash bonuses and put everything into awards that are dependent on us hitting those targets that we set out in November of last year. So you got and I'm talking about the top 250 people in the company, not just the 2 executive directors. So you got a management team that's completely aligned with the shareholders, we're voting with our own wallets to say, we think we can get this bank to where we want it to be and beyond, but it's going to take some time.
But wealth management, for example, in Asia is a crowded market.
It's crowded.
Right. So how do you differentiate yourself? What's your story there?
It's a crowded market, which also means it's a fragmented market. So that market will consolidate over time. And there's a role for different types of players. There's a role for the big Swiss banks who have a very strong offshore offering to ultra high net worth and relatively concentrated client segments. There's a role for local banks who are banking the emerging affluent, and that's a natural place for us. That's our retail business. And there's a role for those in between, which is where Standard Chartered fits in neatly above our retail business. So we have for our private banking clients within our footprint, we have an offshore offering, both in Singapore, in London, in Dubai. We have onshore offerings that are customized for high net worth clients, but also have the benefits of being a local bank with branches. We, in many cases, know the corporations that the individuals are running or owning. So we have a natural sourcing ground for private banking clients, but also an understanding of their business and an understanding of their local requirements and their local needs that's really differentiated relative to other big global banks. So, of course, from time to time, we'll compete with a big Swiss bank, or we'll compete with a local bank in Thailand or Philippines. But we occupy a very nice intermediate ground, which, as a truly global international bank, we're almost unrivaled.
How do you measure success, Bill? Is it the share price? Is it when you pay back dividends? What is it?
Look, it may distress our shareholders to know that I do not watch our share price. I don't watch our share price because it's not influencing what we're doing every day when we come into work. What we want to do every day is tighten up the ship in every way that we can, serve our clients, develop products that are relevant for our clients, understand the competitive environment, respond to it, but then get ahead of it. So we're investing for the medium to long term, 3 to 5 years. Now, that said, we knew and we know that there are things that we have to do right now. We have to be very strong from a capital perspective right now. We have to demonstrate that we're making progress against each of these things that will eventually flow through to profits, because we'll lose the faith of the shareholders, even if we believe ourselves. And we tried to do that in the 8 months since I've been here. So say we're going to diagnose the problems, we're going to be transparent about the problems, we're going to tell you what we're going to do about it, and then we're going to let you track it. And we can't control the price of oil. We can't control the rate of growth in China. We can be prepared for the downside, We can be ready to capitalize on the upside, but we tell you what we're going to do, and we're going to do it. And that's what we're doing. We're doing it.
What's surprised you the most since you've been in charge? Is
Oh.
it your management style? Is it your team, shareholders?
You never know, no matter how well you know an organization from the outside, you never know what you're really going to find on the inside. So I came in thinking that this was a bank with a super strong ethical culture. You know, people come to Standard Chartered because they think they can help change the world. It sounds cliche, but it's true. Our brand promise is here for good. It's real. It's genuine in the bank, and that's great to see. The flip side of that is that there was a looseness to the way that we managed the place, and I'm not blaming anybody for that looseness. I think it came from years of great success where the bank outperformed. And from time to time, I get a hard time from shareholders who say, you know, how could we have seen such a great drop in our share price? I mean, things must have been terrible. I said, well, you're the one that bought the stock at 14 pounds. You know, what were you doing then? I can tell you what you were doing then. You were encouraging management to go faster, to grow more, to book more loans, to get bigger, to get in. I mean, you, Madam Shareholder or Mr. Shareholder, you were encouraging the bank to do the things that ultimately were a partial undoing. Shareholders don't appreciate that, and I'll say what we're doing right now is focusing on what's great about this bank, what we can invest in to make it a lot better, and that's what we're doing.
Bill, thank you so much for your time.
Thank you, Francine.
Thank you. Fabulous. Thank you. Anna Botin, thank you so much for joining us here at Bloomberg. We've seen huge changes from you in the last 12 months. Are we going to see more, or are you happy in where the bank is now?
So the last 12 months have been very intense, the capital raise and changing the dividend policy, but very importantly, the governance, the people changes on the board, not just at the group, but in many of our subsidiaries, and the team. So we changed the CEOs in our 5 big countries and quite a few people at the group level. You know, that is over. You know, we're ready to actually start executing on our strategy.
And so your strategy is what? Simpler and fairer?
So Santander has a very strong base. So we're present in 10 core geographies, 10 countries, and Santander Consumer markets with 1 billion people, where we have 117 million customers. And so everything, our focus going forward is going to be how to do more business with these customers. 100 million are in our banks, and only 13 million are loyal out of 50 million active customers. And so all our strategy is how can we make our customers be better Santander customers. So if I ask you, Francine, who do you bank with? You say, I bank with Santander. That is the heart.
And that makes me a loyal customer.
So, yes. So it's not a very ambitious, that's only a first step. There's much more we can do with you, and there's much more you can do with Santander. But that first step is making you a loyal customer. That when they ask you, you say, Santander is my bank.
So, and no asset sales and no further capital raising.
We have huge potential just to grow with our existing customers. And so we don't need to buy. We don't need to buy. We have and we will continue to look at opportunities in our core markets, but it's not something we need to do.
How do you make a customer loyal? Is it service? Is it marketing? Is it something else?
So I think today you need to do everything right. So I think customers have high expectations. So you need to deliver excellent service, you need to deliver great products, and you need to deliver them in a very cost-efficient way, i.e. the price has to be right. And the best example is our 1-2-3 strategy, which we started in the UK, and we're now rolling out in Spain. And it's a strategy. It's about loyal customer. It's about lasting relationships with our customers.
The 1-2-3 account is something that is actually quite expensive because you give back,
yes,
right, to customers. You do make them loyal, but are you concerned that you're giving too much away? Or actually is loyalty at the moment the most important thing, because then you can grow in years from now?
We want to be the best bank, the best retail and commercial bank for our people, our customers, our shareholders, and our communities. i.e., the strategy has to make sense for our customers, but also for our shareholders. The reason we can square the circle is that we have a best-in-class cost income. We reported in June a cost-income ratio of a bit less than 47%. That is best-in-class among all large banks in the world. And that's what allows us to deliver great products with great prices and excellent service. Now, we're not there yet by any means, and that is exactly what we're going to work on over the next few years, is how we do that in our larger markets.
And what was so successful in the UK that you can replicate elsewhere?
Well, when I arrived in the UK, we were probably one of the worst, if not the worst, bank in the UK in terms of service. And since then, we are now ranked pretty much at the top. And that is very, very important. But also we have, I think, come up with a strategy that customers like. And so we have been the biggest beneficiary of the switching service. We are very much a challenger bank. I'd like to say this. We're a scale challenger, but we're bringing competition to the UK. And I believe that it's a product that pays an interest, gives you cash back, but very importantly delivers great digital experience, for example. And I think that is what UK customers are valuing.
And so that's what you want to be and push forward at a time, I guess, when a lot of European banks are chasing this elusive, high net worth individual, the wealth managers. That's not what you want.
Of course, I want that
as well.
Of course, yes. We want to do retail and commercial banking for the high end, the affluent. Actually, the 1 to 3 strategy. A majority of the customers in the UK are affluent that are coming to us, because even though we are only trying to convert active into loyal, we're actually attracting a lot of new customers. So when I say we want to convert customers and make them loyal, we're not going to tell you not to join Santander from another bank. We welcome everybody.
Is there a bank that you look at and you want to be like a little bit? I'm thinking of Wells Fargo. Is that a right business model or not?
There's many similarities, and I think the potential and what Wells Fargo has done, I admire them a lot in the US, is not very different from what we're doing. The difference is that we have 1 billion people in our core market. So now 9, that's a big number.
Yeah.
So the potential growth, I think, is probably bigger over time.
Your share price has come under pressure. I wouldn't say significant pressure, but under pressure. How much do you think that is out of your control?
Well, I'd like, and I know this is a big ask, but I think we should be measured since we increased capital. So we did a big capital increase at 6.18 euros in January. And we did very well until about mid-April. Our share price was up about 16, 17%, in line or better than most of our peers. Since then, there have been a number of issues. Brazilian banks are down. I think it's 35% since then. Spanish banks are down. Polish banks are down. So, it's the market. I think what's important is that we have shown very, very strong results. So our latest results, our profits were up 25%. We had increased our capital ratio to close to 10%. Cost income, I mentioned, at 47%. And return on tangible equity at 11.5%. These are our June numbers. And very importantly, after having increased our profits the year previously by 30%. So we're doing well. Unfortunately, global growth is slowing down and emerging markets are now out of favor. And so that is not helping us in our share price.
Coming up after the break, we find out how currencies and emerging market volatility play into Santander's business strategy.
Global growth will be slower, so it's obviously going to slow down. China is a big economy. But I think the important thing about Santander is we're very balanced. I think global growth will be slower, so it's obviously going to slow down. China is a big economy. But I think the important thing about Santander is we're very balanced. So 50% roughly of our earnings are coming from developed markets that are huge beneficiaries from what is going on. So, Spain, Germany, we're the biggest consumer bank in Germany with 14% market share. We have a very good business in the US, doing with good returns. We can do much better, but it's doing well. So, that provides a very, very strong buffer against all the emerging markets. I always say Santander tends to do better when things are complicated because we're more stable. When everything is doing very well, we're usually going to underperform. And again, if you look at any point in time, obviously, as I was saying, if you looked at January to April, we did really well. You look April, even January to now. So, I'm quite confident on what we can do for the next few years, in spite of emerging markets, being a bit volatile at the moment.
Talk to me about Brazil. We talked a little bit about emerging markets and the turmoil in emerging markets. Brazil is going through a really, really rough time, independently of what's happening in China. How do you see that business developing?
So our Brazilian business for quite a while actually was not performing as well as we would have liked, and that is quite clear. And I acknowledge we did not do as well as we should have for a number of years. I would say over the last year, last 18 months, we've done much better. So we've made a lot of progress in terms of integration and cost cutting. We have de-risked the bank, which is very important for the times ahead of us. We have strengthened the management also. Recently, we've appointed a new CEO, Sergio Rial. Our current CEO has done a very good job on the team on that side. It's not going to be easy, and I think Brazil has, there's two, let's say, two possibilities. One is the one we believe in. As always, Brazil has had a number of these situations in the past. They've always taken the path of making the reforms, taking the tough decisions, which are not easy for the people, not easy for the economy, and that's what's happening right now. And we believe that's going to continue to be the case. Now, there's another scenario which is more negative, which obviously would mean more years of low growth or recession. We think Brazil has taken the right measures so far, and we are confident that after maybe 15 and 16 or half of 16, we'll see growth again. The currency has, depreciated significantly, and this will allow exports and volumes to grow, hopefully, in the next year. Not now, but a year forward.
How much do you worry about currencies? Do you have a fair value for euro? Because at the moment, it looks like it's going all over the place, and this will have an impact, of course, on Santander.
Yeah, so currencies have been positive for Santander this year. There will probably be negative effect on our P&L next year, right? Because of the Latin American currency. So our businesses, we expect to do, very well, but we'll be dragged down by the currency when we convert our earnings into euros. We hedge our capital 100%, so that's not an issue. It's very difficult to know what the fair value of the euro is. I don't know if it's 115 or 112, 118. Usually currencies tend to overshoot. So, we had the euro at 135, 140. Clearly, that was not, the purchasing power parity was not there. It's probably more at 115. So it's roughly where we are today. If it overshoots, it could go below 1. It's very hard to know. At the end, currencies move according to productivity improvements. So it's a relative productivity improvements in the US or Europe. Again, our business in Europe, we expect to do better over the next few years because our customers are doing better. I was just with a customer in Alicante who buys a lot of things from China, and consumption is going up in Spain, and the cost of all those products they import is really going down. So they're going to be very competitive. Spain has been growing exports in a very significant way over the last 12 months. And so, that should be, that's one of the effects of the cheaper euro.
What's your main concern overall? If we have a global recession, is there something that either the markets or you think bankers, I'm thinking of regulation, are not really seeing at the moment?
Well, my biggest challenge is really executing on a strategy. So, we know where we want to go. We now need to execute. Again, we're a bank. It's not going to be as exciting as the last 12 months. It's not going to be about new people and raising capital. That is over. It's now about executing for our customers and continuing to deliver for our shareholders. And that is a big task, okay? I always think about our people and our team. If we cannot attract the best team. I want to have the best team in the UK, the best team in Brazil. I think we have that today, and we maybe can do a bit more in terms of building and strengthening at second and third level. But I think we're in a pretty good place. And then, of course, the macro, and I think that is the biggest challenge we all have. But as I said, the balance between developing and developed at Santander. So those 10 core markets are in Europe and the Americas. And it's a split between developing and developed, and that's going to give us more stability than others. So if things get quite bad, as I said before, we should do better than others. Now, we will be affected. I think you need competitive taxation. If London wants to be competitive with other financial centres, I think it's very important that the UK authorities understand how they're taxing financial institutions in the UK vis-à-vis other centres. I think with the new changes next year, we're at a disadvantage in the UK. I say we because we are part of the UK. I always say Santander does well in the UK if the economy does well. And I think, banks, and again, we are very much a challenger bank in this country, in the UK, it has to be competitive with other centres. And at the moment, I don't think it is for the next few years.
Are European banks in general at a disadvantage because we're that far behind in maybe getting our act in order, because we're possibly looking at more QE also from the ECB? That hurts your margins.
Well, the US did all the changes. The UK has done most of them. Continental Europe, the rest of Europe is sort of in the process. This has a cost, and so QE needs banks that can then transmit QE to the economy, right? Yeah. So we can make loans and give you a mortgage and fund a startup. Because regulation has still not been implemented in many aspects, so there's still I think I was told in Brussels a few days ago, there's still 300 pending pieces of legislation in banks. I heard the number of 400. So let's say it's between 300 and 400. This means that banks are going to be holding back a bit, even though we're increasing lending. For example, we are increasing lending in Spain right now. But I think there is a drag effect because of this uncertainty and because this regulation is still in the process of being implemented.
You mentioned the US. There are concerns around the US because the Fed failed the stress test on Santander. How are you addressing it?
So I want to say it's not just the Fed, is that we need to meet our own very demanding internal standards, and we're working very hard. The first thing we did is change the team and the governance. We have a new board in the US, a new chairman at the holdco level, a new chairman at the SCUSA level at Santander Consumer, and a new team. So I believe we now understand what we need to do. And our aim is to show significant progress next year on the regulatory agenda. Yeah.
But you're keeping it. There's nothing up for sale.
We're absolutely committed to the US. It's a great country. In spite of the regulatory difficulties, our return on equity in the US is 8.5%, which is not that bad, right? It covers our cost of equity. Our aim is to get to 11% return on equity. But as I said, very importantly, is to meet the regulatory requirements and our own standards.
Do you worry about disruptors, about new entrants? And I know you were saying that the recent research shows that only 2 people out of 10 actually want an only online experience. But how much do you look at the competition? You were talking about offering, for example, Apple Pay as a service.
Apple Pay is not a good business for Santander, but it's a good business for my customers. So I think eventually it will be a great business for us. So we launched Apple Pay in the UK. We were the first group, and our customers love it. And we did it because a significant proportion of our Santander UK customers had an iPhone. So we thought we have to offer them Apple Pay as soon as we can. What is interesting is that we now developed a great app called Spendlytics around Apple Pay, which is making customers more loyal to Santander because you can see where you spend money. It's a great tool, and it's very popular. So I think we need to continue to innovate, and I think that is the key thing. Having said this, I think the important thing is, and I said this recently in Frankfurt at a meeting, we need a fair play market for all. And so the rules have to be the same for banks and new entrants. And I think this is incredibly important. So sharing information, if I share my customer information, the new entrants should share the customer information, because otherwise it's very difficult to run a business. And so I think that is the key thing.
Do you think they will? Do you think that the regulators are looking at this and understanding? Because the problem with disruptors is that they move so fast. Yeah. That regulators have to really understand that market.
Yeah, I think they are. And I think one of the things we're doing also is, and I think there's many of these new companies that are, which we are collaborating. Again, thinking about our customers. So we're working with Apple Pay, Funding Circle. We are the first bank to team up with them. And when I say no to a customer because my lending criteria don't accept his credit or her credit rating, we send them to Funding Circle. So I believe in collaboration with the new entrants, but not with all of them, because some of them are actually, not ready to do that. But I think we are trying very hard to work with the new entrants and also to do our own disruptive strategies.
You are considered probably one of the most influential Europeans across the globe, and in a most influential around the world list, we seem to understand that there are fewer Europeans that there should be, given the population in this region. Why do you think that is?
We need more diversity, and it's not just about women. I think we need more diversity in companies, in boards, and I think women are a significant part of that diversity. I'm very proud that we now have a woman chair in the UK, a woman chair in Santander Consumer, and we're increasing, the programs to support senior women. I think it's a matter of time, but there's a lot of work to do, and I think we need to work together with the men. I always say if I get invited to an event where there's only women, you're preaching to the converted. So we need to work together with senior people in the companies to make sure that we can do something. We need to do more. Clearly, we need to do more. And I think we need to incentivize business leaders to actually do this because it's great for the business. And I'm convinced that it's going to be good, not just for the women, but good for the companies.
And in 3 years, where will you be? And where will the bank be?
So we're setting very ambitious targets. So we want to be, in terms of financial targets, I think, in a very ambitious place. But very importantly, I want us to be the best bank in many more markets. So we're already the best. And when I say the best, it's the best for our people, our customers, also our shareholders and communities. I think in some of the smaller countries, like Portugal or Chile, we're already there. We want to be there in many more of our 10 core markets. And we define best, as I said, not just for our shareholders, but for all our stakeholders.
Anna Botin, thank you so much for speaking to Bloomberg.
Thank you very much.
Thank you.